Canadian real estate, warning signs now flashing that have not been seen since the financial crisis in 2008. In the past, a lack of inventory has been an issue affecting home prices in certain areas. However, according to Bloomberg Economics' recent report on real estate markets across the world, now it is not just low inventories that are driving up housing costs and speculation as well. In New Zealand, Canada, and Sweden, the most risky countries, there appears to be widespread overvaluation based upon indicators such as price growth relative to economic fundamentals like income or rents per square foot. A cocktail of ingredients is sending house prices to unprecedented levels worldwide, according to a recent report by economist Niraj Shah. Record low interest rates, unparalleled fiscal stimulus packages from the government, and expectations for an economic recovery are all contributing factors which have led global mortgage markets up more than 20% in just 1 year. This has been compared with housing price fluctuations during the subprime lending crisis back in 2007. Economists predict that without intervention or changes made soon, we could see another crash on par with America's Great Recession, as well as seeing many potential homeowners unable to afford their monthly payments. This would be due to such high costs per square foot in combination with greater transportation expenses caused largely because people need larger homes far away from major cities where they work every day. The Greater Toronto Area has seen an increase in population by 138% over the past 50 years, with 3.6 million more people being added to that area. This growth is unsustainable and unaffordable for many of those living there now. They must either move out or work hard just to get into a moderately priced home near where they need it. Most do not even have this option. A 7-acre property on Lake Muskoka, which costs $24 million, points towards how quickly things are changing as Canada's wealthiest consider cottage ownership something only accessible through inheritance or immense luck rather than earnable success like it used to be decades ago. The OECD bubble rank is calculated by analyzing 5 indicators, including price to rent and price to income ratios. The higher the reading for each indicator, the greater risk of a correction in prices. Bloomberg Economics found that many countries have more inflated bubbles today than they did before 2008. However, some are even worse off. Even with the risk of a housing crash, rising interest rates and higher lending standards have not yet triggered any such event. And as Shaw points out, the trigger for collapse isn't obvious. In this current cycle where house prices are on an upward trend simultaneously across markets worldwide, as opposed to in cycles past when they peaked at different times, there is more potential for collapsing than ever before. Real estate markets are poised for big shakeup, and these changes could have far-reaching implications.